We shall overcome. Great. So we're still working on inventory. And if I remember very well, we were doing in this case here some question there. Yeah, somebody is interfering with my camera. We shall overcome. We shall overcome. We shall overcome. So we're dealing with inventory management. Specifically, we're doing this question from our past paper, stochastic models, April 2024, question number 2B. April 2024, question number 2, boy. April 2024, question number 2, boy. Once you get it, please put your thumbs up like this live. Already they have the question. Yeah, so the online ninjas, you can tell your colleagues that this class is now ongoing. Even if you are many, we will still prefer to get many more. All right. So April 2024, question number 2B. Question number 2, boy. I read, we are told the management accountant of Lengo Limited has noted that the management and control of inventories has become very uncertain. He has contracted you to devise an inventory system. So he has contracted you as a senior management accountant, so don't let him down. That allows for uncertainties to be applied to the current stock item branded Safi. So I can see their daily demand probability. I can see lead time probability. The daily demand applies for the whole lead time. In inventory carrying cost is 12.5% of inventory value. The purchase cost and order cost are 100 per unit and 59.50 per order respectively. The current reorder point is 120,000. 1 year's 300 working days. So they want us to give them pretty fast EOQ. So how do we get EOQ? It is square root of 2 DCO over what here, somebody? C. Then I can see that demand is probabilistic. Yeah, demand is probabilistic. How do I get this? And remember, it has to be annual demand. So then the first thing that you ought to have done is to give us the average demand. How do we get this? X values times their corresponding probabilities. Because I can see there are 3 demand figures. So we have 3,000 times 0.2 plus 5,000 times 0.5 plus 6,000 times 0.3, which will end up giving us what figure? Yes, 4,900. But do you remember that these 4,900 units are in this case here per day? 4,900 units per day. And yet I want annual demand. So then how do I get annual demand? Annual demand, which will be my capital D here. So it will be this 4,900 times number of days in a year. Number of days in a year, note number 5. How many days do we have there? 300. So then this one here gave us what figure at the end of the day? 1470,000. Thank you so much. 1470,000. Let me ask you another question. Have they given us cost per order? Cost per order, which is our CO. If you look at note number 3, the purchase cost and the order cost are 100 and 59.50 respectively. You see, cost per order will be 15,950. Thank you so much. 15,950. Then we have holding cost. Holding cost per unit per year. Holding cost per unit per year, which is our HC. So I can see from note number 2, they have given me inventory cost as a percentage. It is 12.5%. So this is 12.5%. So it will be 12.5% of purchase cost. So it will be 12.5% of the purchase cost, which was given in number 3. over 100, isn't it? Number 3, purchase cost, the first figure there is 100. So then this one will end up giving us 12.5 shillings per unit. So then my EOQ, my good students, this one here will be equal to the square root of 2 times annual demand, 1470,000, times cost per order, which is 15,950, all over holding cost of 12.5. 12.5. So it will be 2 times 1470,000 times 15,950 divided by 12.5. So first of all, you handle what is inside here. You handle what is inside there. 2 times 1470,000 times 15,950 divided by 12.5. Whatever we get, we say square root, isn't it? Whatever we get, square root of that, which will give us what figure? 61,249 units. Thank you so much. 61,249 units. 61,249 units. Now, once you have that, then now you can go to number 2, where they want us to give them the relevant inventory cost for the year. Relevant inventory cost for the year. Now, remember, I gave you a formula for getting total cost for inventories. We said the total cost will be annual purchase cost plus number of orders times cost per order plus average inventory multiplied by holding cost, like this. This is total cost. But whenever your examiner uses the word relevant, total relevant cost, then we shall always take up only 2 costs. Total relevant costs, this will be ordering cost plus holding cost. So anytime they talk about relevant cost, we have 2 types of relevant costs only. That is holding and what here? Ordering. Normally, the purchase cost is not relevant in terms of decision making. Why? Because regardless of the quantity you decide to procure, if you decide to procure, like say 1,000 units, you see your annual demand is constant and your purchase price is constant. So regardless of the quantity you will decide to go for, the total purchase cost will always be the same. Because you're taking here annual demand times price, purchase cost. So not unless you have discounts where purchase cost is different between different quantities, then this becomes irrelevant. What I want to tell to you this afternoon, ladies and gentlemen, is that whenever this examiner asks for relevant costs, we only have 2 types of relevant costs. We have the ordering cost and then holding what here? Holding cost. So then ordering cost is D over Q. You can just repeat this. So this will be D over Q, CO, plus Q over 2HC. Annual demand, we know the annual demand. The annual demand is 1470,000. The annual demand is 1470,000 over Q. Remember, Q is the economic order quantity, the EOQ, which you guys have already been able to get here, which is 61,249 times cost per order, which is 15,950 plus the same EOQ here, 61,249. 61,249 over 2 times our holding cost per unit, which was 12.what here? 12.5. So then at the end of the day, what numbers are you able to give us? At the end of the day, what numbers are you able to give us? What numbers are you able to give us? How much are we getting, ladies and gentlemen? You can read 2 numbers at a time. 765, 612. Thank you so much. That is what your examiner wanted to get from you. All right. So can I go to number 3 now? Yes. The 12.5. Yes, you see, initially it was a percentage. It was given as 12.5%. And whenever it is given as a percentage, you shall always multiply it with what year? Our purchase price. And what is the purchase price given in note 3? 100, eh? Yeah. So it will be 12.5%. You see, percent is the same as 100 divided by 100 times 100. That is how it was going to remain at 12.5. Thanks for asking a question. Number 3, they want us to give them the current level of safety stock implicit in the current reorder period. In the current reorder period. So it will be very important for us, first of all, to understand what safety stock is. So tell us there that safety stock is buffer stock. Safety stock is the buffer stock. Yeah, that's stock that we keep aside for purely emergency situations. We can only use it for emergency situations. Otherwise, it is not supposed to be used at all. It is the stock that is kept. It is the stock quantity that is kept over and above the quantity to be consumed during lead time. During lead time. Yeah, and that is where whenever you want to get safety stock, i.e. safety stock, you will take in this case here the reorder level given. Reorder level given, and then you subtract demand during lead time. What should be abbreviating as DDLT, demand during lead time. So anytime they ask about safety stock, we shall always be taking the reorder level minus the demand during lead time. So now, ladies and gentlemen, what is our lead time? DDLT. Is there somebody who is able to see our lead time? Do we have lead time? Yes or no? Yes, we do, but you can see they are probabilistic. Yeah, so in short, first of all, give me the average lead time. Give me the average lead time. Give me the average lead time. So is there somebody who can give me this average lead time? Let's see. So the average lead time here, it's probabilistic. So it is X times P summation of XP. Because there are two of them. There are two lead times. So it will be 20 times 0.4. So this will be 20 times 0.4 plus 25 times 0.6. Which then will end up giving me what figure? 23 days. So then can somebody go ahead and give me this total demand during the lead time? Anybody who could give me this total demand during lead time? I'm giving you 1 minute. How much do you expect to consume during lead time? How much do we expect to consume during lead time? How much do we expect to consume during lead time? Sindani, 7,300. I don't know what he did to get that 7,300. 112, 700 units. 112, 700. Because you see, every day we are consuming how much? 49? 49 every day. 4,900. And then our lead time is 23 days. Our lead time is 23 days. So then during this lead time, we expect to consume, or he got safety stock. Okay, all right. So then this one here will end up giving us 112,700, like that. Yeah, 112,700, like that. And therefore, our safety stock, now you have the formula here. So our safety stock will be the reorder level. We can see the reorder level that they happen to be having at the moment. Or they're saying it's 113,700. It's 113, 112, eh? 112, yeah. So then the safety stock will be reorder level, which happens to be note number 4. No problem, Master. You don't have to be sorry. It's learning, it's life. So long as you understand, that is the best thing. So the current reorder point, which is the same as the reorder level, is 120,000. So then 120,000, we subtract 112,700. That is how that ninja was able to get a safety stock of how many units? 7,300 units. 7,300 units. That's how that ninja was able to get 7,300 units. So are we together up to there now? Can I go to the next number there, which wants me to get the probability of stock out? Probability of stock out. So probability of stock out, ladies and gentlemen, this is really an easy one. You draw what you used to hate in high school. Probability tree. Do you like probability trees in high school? All right, or I mean, that is why you are doing CPA today. You liked mathematics, isn't it? You liked mathematics. You liked mathematics. Oh, yes. You liked mathematics. You liked mathematics. Yeah. So then we have here our demand. So we have here daily demand. So the daily demand could either be 3,000, 5,000, or 6,000, like that. 3,000, 5,000, or 6,000, like that. And then, regardless of the demand for the day, we also have what we call lead time. We also have lead time. So you can see lead time. This could either be 20, 25. 20, 25, the same here. 20, 25, the same. Regardless of the demand, we shall have there 20, 25. So we have here 0.2, 0.5, 0.3 probabilities. And then we have here, my good students, I can make this a bit shorter. For the camera to fit. Yeah, that's better. So we have here 2025. And then these probabilities, we have 0.4, and then we have 0.6. 0.4, 0.6, 0.4, 0.6, like that. So I want to check whether I'll be able to run out of stocks. Will I be able to run out of stocks? So then go ahead and give me the total demand here. Give me the total demand. Total demand. So total demand, like now, if this is the possibility, if branch number 1 will be the possibility that we shall be able to have branch number 1, if branch number 1 is the one that happens, I can see demand is 3,000 over how many days? 20 days. So 3,000 times 20, I get the total DD. DD stands for demand, Total demand. How much do we have? 60,000. 60,000. What if it's branch number 2 that will prevail? So branch number 2 will be 3,000, and every day we are consuming 25. So 3,000 times 25, 75,000. All right. Yeah. Yeah. Then branch number 3, 5,000 times 20, 100,000. 5,000 times 25. 125,000. 125,000. Branch number 5 now. 120,000. And then the last one. 150,000. And then remember, we have the current reorder level. We have the current reorder point. So the current reorder point, in this case here, somebody telling me from note number 4, what is the current reorder point? 120,000, isn't it? Yeah, so we have here 120,000. This does not fluctuate. This will remain the same. So remember, the current reorder point is a demand during, it is what we have been able to supply ourselves. So this is supply during, lead time. So have a section for comment. Have a section for comment. So scenario number 1, we can see we have supplied 120 and demand is how much? So are we going to run out of stock? No. Because here we are able to cover the entire demand. So for scenario 1, entire demand is covered. No stock out. No stock out. Because demand is less than supply. Demand is less than supply. So can you kindly finish writing all the others for me? You can even write here, say something like here demand for number 1. Demand is less than what you have supplied. We shall be able to cover the entire. Question, yes, please. A very good student is asking a question here where we have 120 and 120. What will happen? Perfect match, isn't it? No stock out. No stock out. So no stock out here, right? Here, no stock out. No stock out. Here, stock out. Because demand is more, I'll be able to turn away some customers. I can't be able to tell, like how Nakumat used to tell their customers that if you need it, in this particular case here, of course, their guys 5,000 will be turned away. And then we have 120 versus no stock out. Nobody's being turned away. Nobody's being turned, been able to cover the entire demand. How about this one? Stock out, isn't it? So then can you kindly give me the joint probability of the stock outs only? Do you know what is a joint probability from your quantitative analysis? Joint means you're joining two or more probabilities. So like now here, usikazike weke JP from the beginning at zote JP. It is only JP for the stock out, isn't it? JP for the stock out. So then we have here, ladies and gentlemen, we have here, this branch number 4. So we have two probabilities for branch 4, isn't it? 0.5 times 0.6. 0.5 times 0.6. Which gives us 0.3. How about in this case here, this other branch where there is a stock out JP? 0.3 times point what here, somebody? 0.3 times 0.6, which gives me 0.18. And therefore, the entire probability of a stock out will be 0.48, like that. That camera is not very good here. This camera is not very, very good. I'm so sure for the evening students who are with me here today, who are not able to understand it totally when I taught this concept over the weekend, now they're able to understand it much better, isn't it? Great, 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 great. Thank you so much. Thank you so much. Now we go to the other one, the elephant in the room. And once I finish this, we shall be okay. August 2023, question number 5B. August 2023, question number 5B. We are in the same questions, repeating the same questions. August 2023, question number 5E. Of course, the evening, you guys are ahead of the day because I've missed a couple of classes in the day. But the day they have also done variances. So now, and then there is a video that I would want everybody to watch on the LMS, a video on environmental management accounting. It's a 1-hour video which covers all the questions on environment from the past, the last topic, because now we want to start from next week, proper revisions. Everybody, including the evening students who are here, I'm so sure you weren't in that class where I covered environmental management accounting with the special revision students. You know, we have special revision classes. You need to go to the learning management system. You look for that video. It's called environmental management accounting. Watch it and then you compare notes. If you don't watch it, I will be able to punish you. What is our way of punishment? I send you home to bring your parent, isn't it? Yeah, I can't talk with you. I would rather talk with your parent now. What if you are a parent yourself? Is anybody who is a parent? Anybody who is a parent? Sure. Like 2, 3 children. 4. Wow. Great. August 2023. Question number, okay. Have you gotten the question? August 2023. Question number 5A. August 2023. Question number 5A. August 2023. Question number 5A. So we shall move through this question in a slow motion. If you watch people, you understand what slow motion is. Question number 5. It's the most popular question in advanced management accounting, and I'll be able to prove to you. So we are told here, Sanitizer Limited sells sanitizer bottles. The company finds it runs out of stock on occasions and thus loses the contribution on missed sales. Sanitizer Limited works a 5-day week for 48 weeks a year. The demand figures have been analyzed for the last 20 weeks. So additional information, the estimated demand is 60,000 bottles per year. The opportunity cost of running out of stock is how much? 55. The lead time is 5 days guaranteed. The cost of holding a bottle is 50 per year. The number of orders per annum are 10 orders. The demand figures for the last 20 weeks are as follows. You can see the sanitizer bottles sold. Then we have number of days, the level of sales occurred. At present, Sanitizer Limited uses a reorder level of 250 sanitizer bottles and does not carry any safety stock because of the guaranteed delivery time. The demand figures for the last 20 weeks. Okay. Great. So the first thing we need to do is to give our examiner the probabilistic demand. Yeah, so come here, give us the probabilistic demand table. So here the examiner denied us the probabilities. So we have here quantity sold, 150, 200, 250, 300, 350, 400, 450. They have given me number of days. Those number of days you are seeing there basically are frequencies. If you remember the frequency distribution during those old days, when you guys used to be very, very young. Very, very young. Or even now you are young. So number of days. So we have here 7, 14, 35, 35, 28, 14, 7. So how do we convert these to probabilities? It's very, very easy. Please come and give me the total number of total frequency. Give me the total frequency. Hmm? 140, yeah? So then out of these, I will very easily give you the probabilities. The probabilities. So probability, like the first one, it will be 7 over 140, 14 over 140, 35 over 140, 35 over 140, 28 over 140, 14 over 140, 7 over 140. Give me these numbers. So even if we say that you're doing it in a slow motion way, you shall be able to move with speed because we need to finish the question before the class is over. The first one is 0.05, 0.1, 25, 0.2, 0.1, 0.05. You must be having a very rare gift. How do you punch this calculator? That's not normal. Okay. Or the Jersey way. That's very good. It means even your typing speed on a computer is very high, great. By lead time, why are we not multiplying the quantity by lead time? Or this quantity, why are we not multiplying it by the lead time to get what we call demand during what year? Lead time. Now, I'll be able to explain that. I'll be able to explain that in a moment. Good question. Good question. Because these should basically be what we call demand during lead time. Yeah. I'll be able to address that. Don't worry. Now, look at the next thing there. They are telling us that at present, Sanitizer Limited uses a reorder level of how many units here? 250, isn't it? 250. All right. At present, we are using a reorder level of 250 sanitizer bottles and does not carry any safety stock because of the guaranteed delivery time. Ladies and gentlemen, remember the current reorder point has to be a quantity which is within here. So the current reorder point is how much here, somebody? It's 250. Now, Bahati, if you try making this, multiplying the figures here with the 5, the numbers you'll be getting here, they'll be crazy. They'll be crazy. That must have been an error from the side of the examiner. The examiner should have told us that these are sanitizer bottles, in this case here, sold per day. If they told us that this was sanitizer bottles sold per day, then I should have multiplied with what here, the 5 days, for me to get what we call quantity sold over lead time. So in this particular case, we can only make an assumption that this quantity sold is for the entire lead time. It's for the entire lead time. But that will also become clearer as I progress with other questions on the same. All right. Now, ladies and gentlemen, from there, this table, we are okay with it. Now, what we need to do is to go to the next table. There are many tables. The next table will be a supply stroke demand table. So mention there supply stroke demand table. Supply stroke demand table. Supply stroke demand table. So this basically is your table number what here? Table number 2, yes. Table number 2. Table number 2. Now, ladies and gentlemen, we have already known what our current reorder point is. We know our current reorder point is what here, somebody? 250, isn't it? 250. So remember we said, I mean, when you want to know like how many units will be consumed during lead time, it will also be important. It will always be important for you to look at this current reorder point. So the current reorder point is 250. So when it comes to us supplying, we can't supply lower units. No, we don't want to supply like 200. This becomes like what we call salvation. Forward ever, backward never. So in this case here, the 250 that we have here is our current row. Please listen. This is our current row. So when you are writing now your supply, what you will do, you'll write your supply from this current rope moving forward. So you write your supply from here. Moving, the current rope should always be the least figure. Should always be the least figure. So this now becomes your supply figures. What I intend to supply. So we start with the 250, 300, 350, 400, 450, like that. Yeah, so then what I'll do for lack of space, I will start writing this again. Up here. So we have here demand. No, supply. All right. So what do we have here? We have, ladies and gentlemen, 250. Yeah, 250. We have here 300. We have here 350. We have here 400. We have here 400 what here? 50. So do you remember the probabilities? Probabilities, yes. For the 250, who can give me the probability there? For the 250, who can give me the probability there? The same. It is somewhere here, isn't it? 0.25. So we have here 0.25. Then we have 0.25. Then we have 0.2. Then we have 0.1. And then we have 0.0 what here? 0.05. All right. So we have supply there. We have probability here. Now listen. The same numbers are the numbers that I'll be able to come and put here. 250, 300, 350. We have 400. We have 450 like that. And if I'm using this approach here, I found this approach to be very, very nice. I found this approach to be very, very nice. If you're using this approach, ladies and gentlemen, let's change this. Let's change this. Yeah, you know, there are two approaches. If you're using this approach, let's change this. Sorry for that. Please write this one here is demand. This is demand. And then you write here supply. I found this approach to be very good. This approach to be very good. So that we do our workings down here. Instead of doing them by the side here, we shall do our workings down here. So we start with the current rope. The current rope is 250. Yeah, and then we move down. But now these are demand figures and these are supply figures. Now, ladies and gentlemen, please listen. This is a slow motion I want us to talk about. Slow motion I want us to talk about. So this slow motion is so nice. It's really, really nice. This slow motion is really, really nice. This slow motion is really nice. Now, ladies and gentlemen, we ask ourselves a question. If I supply 250, and then we have in this case here, demand being 250, how many people will I disappoint? Nobody. Thank you so much. Nobody will be disappointed. If I supply 250 and there are 250 people demanding, then zero. What if I supply 250 and then customers come 300? 300 come. I will send away how many? I've supplied 250, they've come 300. I disappoint 50. If I supply 250, remember I'm on the line of 250, 250 versus 350, I disappoint. 250 versus 400, I disappoint. 250 versus 450, I disappoint. Please write up to there. Write up to there. And then if possible, come and track the supply of 300 using the same logic downwards. Using the same logic downwards. Using the same logic downwards. So remember, the smallest you start with here is the same you start here with. Same table, same table, the same table. The same table. Is there somebody who is tracking the 301? Able tracking the 301, trying to see the disappointments? I can see Rina, I can see Mary, I can see Yvonne, Masimbudia. Great. Let me then ask you a question. If we supply 300 and then we have demand of 250, how many shall we disappoint? None. Zero. Thank you so much. Because you see, this demand, supply table will also help us to carry out what we call a stock out analysis. A stock out analysis. So the first one will be zero, second one will be zero. But now here demand is becoming more than supply. Remember, we only have a stock out, a disappointment, whenever we have demand being more than supply. So here the stock out will be 50, 100. Oh, they are silent. 150, like that. So our slow motion way up to here, are we really together? Up to here, are we together? Yes, right? Thank you so much. How about this one? So this will be 0, 0, 0, 50, and then 100. 0, 0, 0, 0, 50. 0, 0, 0, 0, 0. So come and give us, if we supply 450, we shall never have anybody disappointed. So then come and give us the expected stock outs per order. So how do we get this? It is summation of XP. Summation of XP. So for the 250, you will take 0 times this, plus this times this, plus this times this, plus this times this, plus this times this. Give me an answer. So we are getting expected stockouts for each supply level. for each supply level. So you see, this has a corresponding probability. So 0 times 0.25 plus high, Tony, great. 50 times this, plus this times this, plus this times this, plus this times this. We're getting 57 point what here? 57.5. Thank you so much. Thank you so much. You are able to follow, right? Now we go to the second one. The second one. The second one. Second one, when supply is 300, I can see the figures versus the probabilities. I can see the figures versus the probabilities. So Ken, great student, is giving me a figure of 27.5. 350. Ten, eh? That's absurd. 10. They have confirmed it. It's 10. It's 10. And then 400. 2.5. Then this one will be 0. So we shall take our 10 minutes break. When we come back, we shall be able to finish our question. Everybody shall take a break. Everybody, please, wherever you are, even if you are in this room with me, you shall take a break and you shall stretch. You shall stretch. Even the online students, take a 10 minutes break. When you come back, everybody should be very fresh to finish this question like the real ninjas. Like the real ninjas. So shall come back at exactly 306. Great. So then let's continue. Now, whatever we have here are expected stock out units per what? Yeah, somebody per order. So you must give us number of orders in a year. So in this question, are you able to see the number of orders in a year? So number of orders in a year, they have given us somewhere. Not number 5. Number of orders in it, they are 5, isn't it? So we have here number of orders. 10, yes. So that will be 10 across board, regardless of your supplies. So then give us annual stock out units. So this will be 575. 575. This will be what here, somebody? 275. And then we have what here, somebody? 100. 25. Then lastly, we have a 0 there. Lastly, we have a 0 there. So then my aim will be to convert this to stock out cost. So I want to convert this to stock out cost. Is there a question there? I can see a student answering a question. I always like knowing the questions that students. Peggy Mugai also answered. Assist the expected stock per order. Assist how we got the expected stock per order. How we got this. Expected means that we are using probabilities. So for the 250, we are taking XP. So these are the X values times the so 0 times this, plus 50 times this, plus 100 times that, plus 150 times that, plus 200 times that. That's how we got the 57.5 Peggy. So please try to see whether you'll be able to get it by yourself. And Marcy has even given you a better explanation. Marcy has given you there a better explanation. All right. So then what I want you to do for me, what I want you to do for me, Give me the stock out cost per unit. Are you able to see the stock out cost per unit? We haven't done much really. We simply say that these are expected stock out cost, stock out units per order. And then we have number of orders given there in note number 5. The number of orders are 10 across. So we're taking here 57.5 times 10. But you can write this very fast. So the stock out cost per unit, anybody who is able to see an answer? A figure, I mean. Thank you, great. Stock out cost per, they don't want to talk to me. It's given somewhere there. It's not number 2. The opportunity cost of running out of stock is 55, isn't it? So 55 across. So then this one will end up giving us the stock out cost. Actually, annual stock out cost. You multiply annual stock out cost. So 575 times 55. I expect you to give me numbers. I hope you're able to catch up. And in case you're not able to catch up, ask a question or even ask Mwalimu to repeat. I'm always happy to help, always. I have testimony about helping. The more you help, the more resources you make outside here. 275 times 55. 15,125. 5,500. 13,75. And then lastly, 0 there. 0. So that is it. So you go to the very last table. So on the very last table, what do? You'll be able to give us the costing table now. Last table, you give us the costing. So the last table, give us the costing, total costs, total cost table. And then remember that our total cost for safety stock, our total cost will be, stock out cost plus, in this case here, holding cost. This is for safety stock. For safety stock. That's how we get our total cost for safety stock. You take the stock out cost plus holding cost. Let me lift my camera up a little bit. How I wish Bwana Kimeme was good with this. I will teach you, Kimeme, right? Yeah, I'll teach you. This can make you see places that you've never seen before. Yeah. So then we have our supply. This one here, you simply do supply. So supply, you must start from the current reorder point, the 250. Yeah. Then we have our 300. Then we have our 350. 400. Then we have our 450. So you're doing costing of what you're supplying, Then give me a column of safety stock here. Give me a column of safety stock. A column of safety stock. One thing that you're supposed to be knowing, my good students, is that the current safety stock will always have, or the current supply. The very first supply here will have a safety stock of 0. All right. So basically, to get this safety stock, what you're supposed to do, just take the supply figure that you have here. you subtract the lowest amount here. You subtract this 250. Yeah, but of course the 250 will not be like a formula. Don't go to another question that has, for example, a figure of 100, isn't it? And then you say, well, say subtract 250. No, you subtract the lowest from this series. Lowest is 250. So like now the first one here, it will be 250 minus 250. Supplier will be 300 minus 250. 350 minus 250. 400 minus what here, somebody? 400 minus 250. Then lastly, we have 450 minus 250. Give us this. These are our safety stocks. All right. So then go ahead and give us our holding costs. Go ahead and give us our holding costs for the safety stock. So holding cost will be safety stock times. Is this 250 of the reorder level? Yes. It is the same as the 250 that we were given in the reorder level. Yeah. The reorder level quantity, yes. So to get holding cost, you always take the safety stock times HC, eh? So here we don't do Q over 2, eh? Yeah, because safety stock is assumed that we shall be with it throughout. We shall never consume it because there is no emergency. There's no emergency. So then we have here 0, 50, 100, 150, 200, times. Yeah. Is there somebody who is able to see the holding cost somewhere? Anybody who is able to see? 12.5, eh? Oh, where did they get 12.5 from? Are they talking of the old question that we did? We changed. Note number 4, the cost of holding is 50, isn't it? 50. $2,500, eh? This 5,000, right? 7,500. 10,000, eh? Yeah, and then remember the other component of cost is what we call the stock out cost. So stock out cost, we have here 31, 625. We have 15, 125, 5,500, 1375, and 0, isn't it? So give us total cost. So total cost, what do? You add the 2. So we have holding plus stock out. Holding plus stock out. You add the 2. The first one, this one I know it is 0 plus this, giving me 31, 625. Yeah, 2,500 plus this, 17, 625. All right. This is very easy, right? 10,500. The other one is not that easy. 18, 88, 75. Then lastly, we have 10,000. Among us all these costs, this is the best or optimal cost. The best or optimal cost is the lowest. The best or optimal cost, that is the lowest. That is the lowest. So anything to do with this optimal will be best, eh? Anything to do with this optimal will be best. Anything to do with this optimal cost will be best. So like when they want us to give them the optimal safety stock, how much will we be able to quote? 150 or 400? Under the safety stock column. It should be 150, isn't it? So optimal safety stock should be 150, the one that corresponds to the best cost. If they want optimal supply will be what here, somebody, for 400. And you have answered that question fully. You have answered that question fully. Now, have you understood this thing really? Have you? It's very long, eh? It needs practice, oh. And this practice will be the August 2022 question number 4B. I told you this is really, really very, very common in your exams. August 2022. August 2022. Question number 4B. I floated along the way. That will be very hard for me, Mercy, to assist you. I wish you just pinpoint the area that you would want me to do what here to help. Because you see, if you floated, you would want me to repeat the whole question really. 1.5 hours. International disaster. Just always tell me, I mean, here. Yes. Roman? Ah, yes. Roman 2, yes. I almost forgot that one. Roman 2, they want us to give them probability of what here, somebody? Stock out, isn't it? Probability of being out of stock. Can you guess the answer? Can you guess the answer? Guess, yes. Yes, before I repeat. Zero point. Just guess the answer. Even if 0 point. The online guys, nobody's guessing anything. 0.05. Online guys are saying 0.05. Are you agreeing with this online ninja? 0.25. Guesswork, eh? 0.05. You see, there is only one possibility. If we supply 400, there is only one possibility of us running out of stock. Remember, our demands were the same year. So if we supply, remember, you're supplying 400. So probability of running out of stock is probability that demand will be more than 400. And that is the probability of what here, somebody? 450. Let me repeat that. Probability of running out of stock. Probability of running out of stock. Probability of running out of stock. This will be probability that demand exceeds 400 that we supply today, which will be the probability of demand being equal to 450. And fortunately, we have this probability somewhere. Do you remember that probability of 450? You're going to kuja ngapi? 0.05. Thank you so much. A good student called V is asking, what if, for example, we had another one here like 500, eh? Yeah, having a probability of, say, 0.03. You multiply? No. But at least you're still guessing, right? You see, the probability of demand exceeding 400 will be the probability of demand being 450, or a probability of demand being 500. Or in probability means what here you add, eh? You add. Would have added the two probabilities. Is that okay? Would have added the two probabilities. Thanks for asking. This ninja called Maslin wants me to do this table, no problem. You see, here we were looking at the total cost table, eh? Yeah, and we were trying to get the safety stock. So how do we get safety stock? Our quantities. Yeah, those quantities which we had in the other table, right? And then to get the safety stock, we have a formula here. You take supply minus the lowest value here, which is 250. So supply minus 250. So like now the first one, the supply is 250 minus 250, 0. 50 like that. And then once we got that, we were able to write down the holding cost for our safety stock. which are these numbers, times our holding cost per unit. And the holding cost per unit has been given on note number what here? Holding cost per unit has been given in note number 4, 50. So you take like 0 times 50. If we have 50 units, then the holding cost total for a whole year will be 50 times 50, 25, like that. And then the stock out cost, these are the figures we had gotten down there. You remember. So like the stock out cost for the 250, we look at your table down there, the earlier table, you'll be able to see that 31,625. So we're able to copy that, and then we added the two numbers to get our total cost like that. I want to believe you will be able to follow now that easily on the video. In case of any question, you can always reach out to me. So August 2022, question number 4, boy. Great. Question number 4, boy. Mwamba County. Are we there? So Mwamba County Water Treatment Plant purchases 100 kilograms of lime bags for use in the water treatment process. The number of bags used per day varies on the basis of water consumption. Examination of past records discloses the following: usage during past reorder period, number of bags. And then you can see number of times this quantity was used. The EOQ has been established at how many units? 2,500, with an average daily usage of 25 bags and a lead time of 15 days for each single product X. Additional information: stock out cost is 300 per bag. 2, the current number of orders based on the EOQ, 6 times. The normal carrying cost is the same as holding cost, 50 per bag. So advise the management accountant of Mwamba County on the desired level of safety stock in order to minimize total inventory cost. August 2022, question number 4B, yes. So this question is a replica of what we did, what we've just done. The only thing that I know my students here will not be able to get, I know what they will not be able to get. You see, in the other question, they gave you the current reorder level. This one, they haven't given you the current reorder level. So what do you do in an exam cry? Current reorder level. Current reorder level. Can somebody tell me? Guess. Today we are guessing. Current reorder level. Reorder level, which will be the same as current reorder point. I gave you the formula. Some time back, I gave you the formula for this. Daily usage times lead time. So in this case here, we are taking demand times lead time. And this great lady has been able to see that lead time has been given in terms of days. In terms of days. So in that case here, this has to be demand per day times lead time days. Times lead time days. So demand per day is how much? I'm alone, but I will overcome. Demand per day before the additional information. Are you able to see 25? Times lead time? 15 days, isn't it? So 25 times 15 gives me 375. 375. Unfortunately, if you look at your demand distribution, 375 is somewhere there. So you start now rolling the ball, and you roll it much faster because this can really waste your time in an exam. So you need to know how to roll the ball pretty fast. Is that okay? Roll it. And I will be able to check your answers on WhatsApp. Everybody should be able. By the way, I've never seen you guys doing any question and sending it on WhatsApp. Especially the day students, even the evening students. I've never seen, not even a single day. Does it mean that this semester I got geniuses for students in AMA? Like now I'm very, very free. I've closed my audit business, not closed it. I mean, for the year. As a partner now, you're not signing anything much. Now I'm very, very free. I would want to be marking those things. You do, you send on WhatsApp. You send on WhatsApp. 2 things I never get my students here this semester. They don't do any work and send the work to WhatsApp, and they even don't call me. Is there anybody who has ever tried calling me? No. Why? And I'm your father. You should call him even when you are arrested by a city council soldier outside here. I'm the best you should call, isn't it? You'll call. We shall overcome. All right. Or you assume I'm busy, we shall overcome. Not now moving forward.